Assalamualaikum to Puan Ausan. My friends and I will present about financial accounting. My name is Nur Shawaliza. I will present about question 1. My friends Farhana Shazwani will present about question 2. And lastly, Darshini will present about question 3. As the first presenter, me, as a Nur Shawaliza binti Shahrudin, I will present about the basic accounting concept. First, we need to know about accounting principle. What is accounting principle? Accounting principles are the general rules and guidelines that companies are required to follow when reporting all accounts and financial data. The purpose of following principles is to be able to communicate economic information in a language that is acceptable and understandable from one business to another. Accounting principles ensure that companies follow certain standards of recording how economic events should be recognized, recorded, and presented. There is 11 topics that I need to explain, such as the objectivity concept, the historical cost concept, the money measurement concept, and others. I will explain and give an example. First, the objectivity concept. What is the objectivity principle? Financial statements must be presented with supporting evidence. Aims at making financial statements more relevant, accurate, and reliable, for it will be used to predict future company performance. Objectivity concept of accounting defines and states that while preparing the financial statements, the accountant should try to use data which is as objective and reliable as possible. In other words, the accounts should be concerned as far as possible with the facts and as little as possible with the opinions. For example, Ahmad, an accountant, is in charge of preparing financial statements for Elite. Ahmad asks for company records to support its payable and receivables, but the company says it will be too much work to get and just go with numbers in the accounting system. Now I will explain and give an example about the historical cost concept. Historical cost of an asset refers to its purchase price or its original monetary value. Based on the historical cost concept, the transactions of a business tend to be recorded at their historical cost. The concept is in conjunction with the cost principle, which emphasizes that assets, equity investments, and liabilities should be recorded at their respective acquisition costs. This is an example from historical costs. For instance, when KFC buys a cash register for Rm70,000 by paying Rm30,000 and promising to pay 40,000 ringgit within a reasonable period of time, it should record the asset as it at its price when they bought it, which is. Now, let's talk about the money measurement concept. The money measurement concept states that a business should only record an accounting transaction if it can be expressed in terms of money. This means that the focus of accounting transactions is on quantitative information. rather than on qualitative information. Thus, a large number of items are never reflected in a company's accounting records, which means that they never appear in its financial statements. Examples of items that cannot be recorded as accounting transactions because they cannot be expressed in terms of money include employee skill level, employee working conditions, expected resale value of a patent, value of an in-house brand, product durability, the quality of customer support or field service, the efficiency of administrative processes. All of the preceding factors are indirectly reflected in the financial results of a business because it have an impact on either revenues, expenses, assets, or liabilities. For example, a high level of customer support will likely lead to increased customer retention and a higher propensity to buy from the company again, which therefore impacts revenues. Or if employee working conditions are poor, this leads to greater employee turnover, which increases labor-related expenses. Now, let's look at the going concern concept. First, business is expected to continue indefinitely. Implies that the business will continue its operations and will neither liquidate nor be forced to discontinue operations due to any reasons. If evidence is available to believe that it will or will have to cease its operations in foreseeable future, the company is no longer a going concern. Following evidences such as series of losses, loan defaults, denial of trade credit by its suppliers, uneconomical long-term commitments and legal proceedings. Now, for example, an example of the application of going concern concept of accounting is the computation of depreciation on the basis of expected economic life of fixed assets rather than their current market value. Companies assume that their business will continue for an indefinite period of time and the assets will be used in the business until fully depreciated. Another example of the going concern assumption is the prepayment and accrual of expenses. Companies prepay and accrue expenses because they believe that they will continue operations in future. Next, the separate entity. The separate entity concept states that we should always separately record the transactions of a business and its owners. The concept is more critical in regard to a sole proprietorship, since this is the situation in which the affairs of the owner and the business are most likely to be intermingled. The separate entity concept should also be applied to the operating divisions of a business, so that we can separately determine the same information for each division. The concept is more difficult to apply at the division level, for there is a temptation to allocate corporate expenses to each of the subsidiaries. This makes it more difficult to ascertain profitability and financial position At the operating unit level, once the policies and procedures for the accounting for a separate entity have been stated, they should be followed consistently, otherwise there will continue to be a gray area in regard to transactions belonging to the owners of the separate entity. For example, an owner cannot remove funds from a business without recording it as either a loan, compensation, or an equity distribution. Otherwise, the owner may buy something such as real estate and leave it on the books of the business, when in fact the owner is treating it as a personal possession. An owner cannot extend funds to a business without recording it as either a loan or a stock purchase. Otherwise, undocumented cash appears in the business. An owner is the sole investor in a building and arranges to have his business operate from that building in exchange for a monthly rent payment. The business should report this payment as an expense and the owner should report it as a taxable income. Next is the accrual concept. Accrual accounting principle is revenue should be recognized when earned regardless of collections. Expenses should be recognized when incurred regardless of payment. For example, when Naura, a dentist, finishes performing her services, she should record it as revenue. When Naura receives an electricity bill, she should record it as an expense even if it is unpaid. Now, let's move to the periodicity concept. The periodicity assumption states that an organization can report its financial results within certain designated periods of time. This typically means that an entity consistently reports its results and cash flows on a monthly, quarterly, or an annual basis. These time periods are kept the same over time for the sake of comparability. For example, a statement of cash flow showing the period covered. This is a period covered. Also this. This is time period. Now, the materiality concept. What is the materiality concept? Transactions should be recorded when not doing so might alter decisions made by a reader of a company's financial statements. This tends to result in relatively small-sized transactions being recorded so that the financial statements comprehensively represent the financial results, financial position, and cash flows of a business. For example, size, a default by a customer who owes only 1,000 ringgit to a company having net assets of worth 10 million ringgit is immaterial to the financial statements of the company. Now, the consistency concept. The consistency principle states that once you adopt an accounting principle or method, continue to follow it consistently in future accounting periods. Only change an accounting principle or method if the new version in some way improves reported financial results. If such a change is made, fully document its effects and include this documentation in the notes accompanying the financial statements. For example, Company A has been using declining balance depreciation method for its IT equipment. According to consistency concept, it should continue to use declining balance depreciation method in respect of its IT equipment in the following periods. If the company wants to change it to another depreciation method, say for example the straight line method, it must provide in its financial report the reasons for the change, the nature of the change, and the effects of the change on items such as accumulated depreciation. Now let's continue to the prudence concept. Prudence concept of accounting states that an entity must not overestimate its revenues, assets, and profits. Besides, it must not underestimate its liabilities, losses, and expenses. For instance, there are many liabilities which are not certain either in terms of amount or in terms of debt, but they have high possibility of occurrence. In such cases, the liabilities are recorded in the statements and a corresponding expense is also recorded. So it makes sure that liabilities are not undervalued. Substance over form. Substance over form is an accounting concept which means that the economic substance of transactions and events must be recorded in the financial statements rather than just their legal form in order to present a true and fair view of the affairs of the entity. For example, an asset may be leased to a lessee without the transfer of legal title at the end of the lease term. Such a lease may, in substance, be considered as a finance lease if, for instance, the lease term is substantially for entire useful life of the asset, or the lease agreement entitles the lessee to purchase the asset at the end of the lease term at a very nominal price, and it is very likely that such option will be exercised by the lessee in the given circumstances. That's all from me. Thank you.
I'm Farhana Shazwani. I am presenter number 2, so I'm gonna continue to explain about importance of the source documents used in the business. Before completing orders and delivering goods or service to customers, businesses confirm orders using a document known as a sales order. What is sales order? A sales order is a document sent by a business to a customer confirming an order. Sales order confirms the details of the order, specifying the products or service ordered by the customer. Why a sales order is important? Sales order are important documents for both business and customer. There are 5 the importance of sales order using in the business. First, sales orders can reduce errors. Sales orders are used by business to confirm that they have accepted to a customer's purchase order. The document includes specific details of the order so that the customer knows exactly what to expect. The sales order should eliminate misunderstandings about what is being delivered, when, and for what price. If a customer receives a sales order and disputes any of the details, they can contact the business and resolve the issue before the order is delivered. Second is sales order reduce late order payments. By clearly detailing the price of an order and the payment terms, businesses also reduce the risk of late payments. Late payments can cause cash flow issues and disrupt business operations. But if customers know exactly what they are expected to pay and when they will be more likely to pay for the order as soon as they receive the sales invoice. Number 3 is sales orders are used to generate sales invoice. Businesses accounting departments will use sales orders to generate sales invoice. Once the sales order has been sent to the customer, accounting teams can create a sales invoice to send to the customer on delivery of the product or service. Number 4 is orders are prepared using the sales order. The specific details included in the sales order will be used by a businesses to prepare orders. Before the business picks and packs the order products, they will check the inventory. If there isn't sufficient inventory, the sales order can be used to create a purchase order for the business supplier. The last one is sales order can be financed. Sometimes a business will receive an order but won't have the funds or resources to fulfill it. Businesses finance solution like convertible order finance can be used to fund the completion of orders. However, before providing funds, financial providers will want to see either the purchase order or the sales order. So, like what I say, sales order confirm the details of order. What the details of the order? Components. So I'm gonna tell the component of sales order. As for example, is name and contact information of the company by the seller, name and contact information of the customer, customer billing information, customer shipping information. For example, when we order the products in website online or Shopee or Lazada, when we receive the parcel, we can see at the in front of the parcel, we can see name of the company and our name, number phone, address, and so on. So that the details of the order. Okay. So next, let's proceed with purchase order. What is purchase order? A purchase order is a commercial source document that is issued by a business purchasing department when placing an order with its vendors or suppliers. There are some of important of purchase order. Number 1 is purchase order can avoid duplicate orders. Purchase order brings several benefits to a company. The most important is that it helps avoid duplicate orders. When a company decided to scale the business, purchase order can help keep track of what has been ordered and from whom. Also, when a buyer orders similar products, matching the invoices can be difficult. The purchase order serves as a check for the invoice that need to be paid. Second is purchase order keeps track of incoming orders. In addition, purchase order help keep track of incoming orders, and a well-organized purchase order system can help simplify the inventory and shipping process. The last one is purchase orders serve as legal documents. Purchase orders serve as legal documents and help avoid any future disputes regarding the transaction. So these are difference of sales order and purchase order. Sales order confirm the requested order and the order details, while purchase order are sent by the customer to a business requesting products or service. Next is delivery order. What is delivery orders? Delivery orders are forms that are used to record goods being delivered to a customer. The delivery order will reduce the inventory quantity and record revenue and cost of goods sold. The importance of delivery order is taking good control of the delivery process in order to make sure that the parcel is delivered to the customer on time. Second is delivery order can increase customer satisfaction and loyalty if the parcel are delivered on time and without loss or damage. Here we can see example of delivery order. Next is invoice. An invoice is a document that lists the products and services a business provides to a client and establishes an obligation on the part of the client to pay the business for those products and services. Next is the importance of invoice. First is foundation for accurate bookkeeping. Sales invoices are an important tool for small businesses because they serve as the foundation for the business bookkeeping system. A sales invoice creates a record of sale. By properly recording and filling all the invoice you send to clients, you will have all the information you need to track your sales, monitor your cash flow, and create robust financial reports. Next is resources for tax returns. Sales invoices are crucial documentation for verifying the claims you make on your tax returns. Third is inventory management tools. If your business sells physical products to each customer, your sales invoice can help you manage your inventory and ensure you always have enough of each product to fulfill your incoming orders. Your sales invoice helps you track how much inventory you have on hand and allow you to forecast how much you will need to future months based on past data. Next is legal protection. Your sales invoice can help protect you from petty or unsubstantiated lawsuits that may be brought against your company. Sales invoice can demonstrate what service your business provided to a client and the timeline for the work. Sales invoices that are signed by clients are particularly useful in this instance, but not necessary. The last one is data for business plans. Sales invoices serve as important data when your business is planning for its future. Sales invoice can offer information on how much revenue you are bringing in and how your earnings have changed over time. You can use the information to do budget forecasting. You can also use your sales data to see how much cash you have available to invest in growing or improving your business. So next is cash bill. What is cash bill? Cash bill is a document receipt of cash payment as opposed to an invoice or promise to pay. The importance of cash bill used in the business is cash bill used to buy more materials, pay wages and overhead, and produce more goods to generate more sales. This is example of cash bill. Next is credit notes and debit notes. What is credit notes? Credit note is an accounting document sent by a supplier to a customer in respect of goods returned for overpayments made by the customer. It is a negative invoice. Remember, credit note is the document sent by the suppliers to customers, not customer to suppliers. The invoice that suppliers send to their customer probably contain the items that customer reject, return, as well as the payment made from customer may be overpaid. If that case happens, suppliers normally send the credit note to make the cancel or as the result of the request from customer. The request from customer normally done by a debit note. Okay, so what is debit note? Debit note is a document sent by a customer to a supplier in respect of goods returned or an overpayment made. It is a formal request for the supplier to issue a credit note. So let's assume you are the accounting documents and there are few items in the invoice that you receive from the suppliers. They are not received or rejected by you. That means the invoices are overstated. At this stage, you have two simple options. One is requesting your suppliers to reissue the invoice, or you asking them to issue the credit note to reduce the amount in the invoice. If your choice to asking them to issue the credit note, you have to issue the debit note to them. Okay. This is important of credit note and debit note in a business. Debit note, debit note are issued always by buyer for the amount debited on account of the seller with a valid reason. Second, debit notes affects purchase return book. A debit note is issued only on credit purchase where buyer wants to reduce the amount for many reasons possible like delivery of defective product. Next is important of credit note. Credit note are legal documents just like invoice that give you the important ability to cancel out an already issued invoice, either in full or in part. Issuing a credit note essentially allows you to delete the amount of the invoice from your financial records without actually deleting the invoice itself. This is an example of debit note and credit note. Next is official receipts. Official receipt is a document that provides evidence of a sale of service by or to a business. Official receipt should be issued by the business performing the service immediately upon receipt of payment from a customer for that service. There are three important of official receipt. Number one is represents from a financial transaction. Number two is receive or issue in business to business dealing as well as stock market transaction. The last one is receive are also necessary for tax purpose as proof of certain expenses. So this is example of official receipt. Okay, next is payment voucher. Payment voucher are used to record payments or to vendor and to maintain payment history. Once posted, they can be added to checks or quick checks for processing and printing checks. The voucher is important because it an internal accounting control mechanism that ensures that every payment is properly authorized and that the goods or service purchased are actually received. Important of payment vouchers is a voucher is a document used by a company accounts payable department containing the supporting document for an invoice. A voucher is essentially the backup documents for account payable, which are bills owed by companies to vendors and suppliers. Documents in a voucher can include the supplier's invoice, amount owed, due dates, general ledger accounts, and shipping receipt. The last one is all the amounts of outstanding vouchers are total and the one lump sum is recorded as account payable on the balance sheet. This is example of payment voucher. Next is memo. A memo entry is a transaction that contains no posting to the general ledger. This entry is used for stock splits, where the number of shares outstanding change, but there is no alteration of the underlying equity accounts. The entry used to denote the change in shares outstanding. We can see the example of memo. So the importance of memo in a business is issuing order and instruction, affirming any change in policy, providing and seeking suggestion and recommendation, requesting for help. Memo can use for requesting for help, requesting for information, informing decision, and using as a reference in future. Next is check. Check is document which orders a bank to pay a particular amount of money from a person account to another individual or company account in whose name the check has been made or issued. The check is utilized to make safe, secure, and convenient payments. Why is check is important in business? Okay, so check is it is more convenient than carrying cash around. So we don't need to bring a wallet and lot of money. Okay, check also the importance of check is payments can be stopped if necessary. Okay, checks are safer if crossed. One does not have to count notes and risk making counting mistakes. A check can be drawn up anytime. Some are negotiable and can be endorsed in favor of a third party. Check also they can be post-date. Uh, by the way, check also can be tracked if lost. And the last one is check it can be post-mortgaged. That's all from me. Thank you.
Hello everyone, I'm Darshini Krishnamurthy. Now I would like to continue explaining functions about journals and ledgers. First, purchaser's journal. A purchaser's journal can be defined as the main entry book which is used to record credit purchases transactions. For this question and following questions, I will record the transactions on behalf of good cooking or trading. This is an example of invoice. The owner will receive or send invoice when the transaction is on credit. First step, we should identify whether the owner received or sent the invoice. For these questions, the owner will receive the invoice. If the owner received invoice by the supplier, that means the owner made purchases on credit. Next step, we record the transaction into journal. On 2013 June 24th, Best Cooking Oil by RM 2880. If the owner made more than one purchases, we gonna total up the amount and write it on June 30th as purchases account debit. The debit shows expenses increasing. Second is sales journal. A sales journal can be defined as the main entry book which is used to record credit sale transactions. As I told, first we should identify whether owner received or sent invoice. For sales on credit, the owner will send the invoice. Next, we're going to record this transaction into journal. 2013 June 5th, Pizza Cooking Oil by RM 2700. Next, total up the amount, write it on June 30th as sales account credit. The credit shows revenue increasing. Third, written invoice, also called as sales returns, used to record goods sold written by the buyer or customer. This is an example of credit note. The owner will receive or send credit note when the goods purchases or sold returned to the supplier. First step, we should identify whether the owner received or sent credit note. For sales returns, the owner will send credit note to the supplier. That means goods returned by the customer. Next, record the transaction into written invoice journal. 2013 June 14th, Visa Cooking Oil by RM 270. Next, total up the amount and write it on June 30th as returns inward account debit. The debit shows revenue decreasing. Next one, written outwards, also called as purchases return, used to record purchased goods returned to the supplier. This is credit note received by good cooking or trading. If the owner received credit note, that means goods returned to the supplier. Next, we record the transaction into written outward journal. On 2013 June 12th, Sunflower Cooking Oil by RM 94. Total up the amount and write it on June 30th as written outward account credit. The credit shows expenses decreasing. Last one is general journal. General journal is used to record non-cash transactions. This journal excluding purchases, sales, and returns of goods. This is an example of memo. I choose memo as for an example for record the transaction into general journal. The memo shows the owner took cooking oil for own use, that means drawing in accounting. Next, we're going to record this transaction into general journal. On 2013 June 22nd, debit drawing by RM15, credit cooking oil by RM15. In accounting, drawing is on debit side because drawing will decrease owner's equity. Lastly, write to cooking oil for own use and explanation. Next, I would like to explain about ledgers. A general ledger represents the record-keeping system for companies' financial data. Each financial transaction affects at least two sub-ledger accounts, and each entry has at least one debit and one credit transaction. Double entry transactions called journal entries are posted into two columns with debit entries on the left and credit entries on the right, and the total of all debit and credit entries must balance. As the general journal shows, when we post journal entry into general ledger, you debit the left hand side of your drawing by RM15. Next, you credit the right hand side of cooking oil by RM15. Now, your ending balance in drawing account is RM15, which you carry forward into the next month. Same goes to cooking oil account. The balance will carry forward into the next month. Second one is sales ledger. As the sales journal shows, when we post journal entry into sales ledger, you credit the right hand side of sales account by RM 2700 as debtor because our revenue increasing, and the debit the left hand side of debtor account by RM 2700 because our asset increasing. Next, when we post from written invoice journal into ledger, you debit the left hand side of written invoice account by RM 270 as debtor because our revenue decreasing, and credit the right hand side of debtor account by RM 270 because our asset decreasing. Now your ending balance in sales account is RM 2000, which you will carry forward into the next month. Your ending balance in debtor account is RM 2430, which you will carry into next month. Next, your ending balance in written invoice account is RM 270, which you will carry forward into the next month. Last one is purchases ledger. As the purchases journal shows, when we post journal entry into purchases ledger, you debit the left hand side of purchases account by RM 2880 as creditor because our expenses increasing, and credit the right hand side of creditor account by RM 2880 because our liability increasing. Next, when we post from written outward journal into ledger, you credit the right hand side of written outwards account by RM 94 as creditor because our expenses decreasing, and debit the left hand side of creditor account by RM 94 because our liability decreasing. Now your ending balance in purchases account is RM 2880, which you will carry forward into the next month. Next, the ending balance in creditor account is RM 2786, which you will carry forward into the next month. Lastly, the ending balance in written outwards account is RM 94, which you will carry forward into the next month. That's all from me. Thank you.